Hello and welcome to lesson 3 of our 11-part stock analysis course. In the previous lesson, we learned how to navigate the annual report and identify the sections that matter most when analyzing a company. Now we're moving from yearly reporting to something investors follow much more frequently, the quarterly reports, also known as thank yous. These filings help you track how the business is evolving throughout the year and spot changes early. Let's jump in. The annual report tells you how a company did over the full year, but a year is a long time in business. Things change, revenue trends shift, problems emerge. That's why companies also publish quarterly reports every single quarter, and knowing how to read them gives you a real-time pulse on the business. The thank you is not audited the same way the annual report is. It's reviewed but not fully audited. It's still a legal document filed with the SEC and follows the same structure as the 10K, just condensed. Here are 3 things I focus on specifically in a quarterly report. Year-over-year comparisons. The most important comparison in a thank you is not quarter versus the last quarter. It's this quarter versus the same quarter last year. Why? Because many businesses are seasonal. A retailer will always have strong Q4 because of the holidays. Comparing Q4 to Q3 would be misleading. Always compare the same quarter 1 year apart. Changes in the management discussions and analysis language. Read the MD&A section of the thank you and compare it to the previous quarters. Are they using new language? Are they suddenly mentioning risks they didn't before? Has their tone around guidance become more cautious? Small changes in language can signal big changes in business. Also, updated guidance. Companies often update their full year guidance in quarterly reports. If a company started the year expecting 15% revenue growth and has now revised that down to 8%, that's significant. Track guidance changes across all 4 filings each year. Okay, let's proceed with some red and green flags. An example of red flags in thank you are revenue declining year-over-year for 2 or more consecutive quarters, gross margins compressing without explanation, rising accounts receivables faster than revenue. This could mean customers aren't paying. Unusual one-time charges appearing repeatedly. They are not really one-time if they keep appearing. And also, some green flags are if the revenue is accelerating, specifically when the growth rate is increasing, not just the absolute number. Margins are expanding. This means the company is becoming more efficient. Management raising full-year guidance is a good sign as well. Free cash flow growing faster than the net income is also really good. These are the most important things to keep an eye on in thank you. Here's your action step after this video. Open the latest thank you for a company you follow and compare it to the previous quarter's report. Focus on 3 things: revenue growth, margin trends, and any changes in management language or guidance. Don't worry about understanding every line immediately. The goal is to start building the habit of tracking the business quarter by quarter, because investing is not about reading one report once. It's about following the ongoing story over time. If you found this lesson helpful, make sure to like the video and subscribe for the channel, so you don't miss lesson 4, where we'll go behind the numbers and learn how to read the earnings call transcripts, one of the most underused but powerful resources available to the investors. And as always, drop a comment with the company you're currently researching or any questions you have. See you in the next video.